Hello, if you're joining us, we're going to give a couple minutes for everyone to join us. It's just now 5:30 here in Central Time. People are rolling in here. So let's give them a couple minutes. Please be patient, and we'll get this webinar started here. Okay, people still rolling in. Love seeing this. Everyone's joining us this evening. This is looking good. I hope y'all are excited as I am about the year end. Okay, I think we should get going here. Um, People will be able to join us. I want to introduce myself. Good evening, everyone, and welcome to Beauty and the Bucks, year-end tax strategies for your aesthetics pros. I'm George Beach, your host here at Medical Purchasing Resource and mastermind behind medpurchasing.com, where we bring MedSpa owners, aestheticians, and beauty trailblazers all of the premium products and supplies necessary to keep your practices running. First off, I want to give everyone a huge thank you for joining us tonight, especially on this Thursday evening when your schedules are buzzing with glow ups and client consultations, especially as the holiday seasons creep up on us. Whether you're turning in from our bustling city of New York City or a serene spa in LA or somewhere in between, I'm thrilled you're here this evening. We've got a packed house already with over 100 plus aesthetic pros ready to reclaim the hard-earned bucks from Uncle Sam. If you're just popping in, make sure to drop a quick hello in our chat with your city. Love seeing our community vibe out here. Tonight's all about arming you with all the actionable year-end tax moves that can save you thousands before the clock strikes midnight on December 31st. We're talking depreciation hacks and all the shiny new dermal infusion systems, smart supply buys to slash those taxes, and making sure you know about the 2025 tax changes. But enough for me. I'm just the guy who loves connecting smart folks like you with game-changing insight. Our real MVP tonight is the brilliant Nicole McClintock. She's a CPA and founder of Taximize. Nicole's a tax wizard who has helped countless aesthetic businesses navigate the wild world of IRS rules, state taxes, and everything in between. With her no BS approach and deep expertise in federal and state strategy, she's going to break it all down for us in a way that's practical, profitable, and dare I say, actually fun. Nicole, the stage is yours. Take it away and let's make those tax bucks work for you.
Thanks, George. I think you set a high bar. I'm going to actually make taxes fun. I don't know. That is a challenge. I'm going to share my screen here. Okay. Okay, so George has already introduced me. I am the founder and owner of Taximize. I work with a lot of aesthetic pros, med spas, I mean, you name it. I help them find that extra tax dollar here. Um, George, he's absolutely wonderful to work with. He's at Medical Purchasing Resources. He can really help you with some of these tax strategies that I'm putting in place and help you pull some of the triggers on some of these things to help bring you that dollar today. Today we're going to be going over a few different areas. This is all going to be really high level. Don't want to put you guys to sleep here. It is the end of the day. These are all things that, I can go into deeper detail with you and that we could analyze and see if it'd be something that could bring a benefit to your business. But we're going to talk about year-end purchases. What can we do there to help save in taxes? How is purchasing equipment? It can save you thousands in taxes. The new FICA tip credit. This has expanded out. Historically, this has only been applicable for restaurants, and now it is in your space, and it is absolutely a wonderful thing that you need to make sure you can take advantage of. There's also the new employee tip and overtime deductions. And then I'm going to go over a few other areas of where there could be some really good tax savings for you. And then we'll have a Q&A. So let's dive in and talk about what can we do with year-end purchases. But before we talk about that, first and foremost, I want to talk about cash flow. It's really important that you aren't just spending a dollar to save on taxes. You need to make sure that your business can handle that and that you actually have the cash flow to make these types of tax moves. So make sure that you have the cash flow to cover your existing expenses, your fixed expenses, and your variable expenses, and that you're not dipping into that emergency fund. And that also, as a business owner, make sure that is there enough cash left in there for you to be covering your own personal expenses and what you were needing. It's really, really important that you understand the cash flow of your business. It's important to remember too, these last couple months here is usually a huge influx of business for you guys, and you have a lot of extra cash, but then January and February can be a little bit slower. So make sure to plan for that as well when you're making these kinds of decisions. So, okay, enough with that. I'll take off my, CFO hat here, and let's actually talk about where we can have some tax savings. So there's opportunities here at the end of the year. Obviously, you're probably pumping through a lot of different supplies. You're using things up. And so maybe it would make sense, let's stock up. Let's, purchase a bunch of items that you're going to be using throughout the next year to pull in those expenses into 2025 so that you're saving the tax dollars and you have more to spend in your business today. So, it really can make sense to do this, but also be cognizant of the fact, are you purchasing, items that have an expiration date? So make sure you're not overstocking and then you're going to end up having waste. Those types of things is really important that you just don't go out and spend. But you could do that, or let's say maybe you're looking at doing a new marketing campaign. And so you're going to purchase a bunch of Google ads. Maybe purchase a bunch of those that you're going to use in the next year, but pay for them now today. And, a lot of med spas are on the cash basis. And so those expenses are deductible today. That could make a lot of sense. That's a great way of, marketing out and getting new clients, which does take more effort to be getting those new ones. But planning for that is a great way to get some extra expenses here in at the end of the year. Also, maybe do some holiday type kind of gifts for your employees and or for those, really great clients of yours. And there's ways that you aren't going to get hit by the $25 cap of that's the only amount that's deductible. There's ways around this that you can work this and turn it into marketing as well. So try and take advantage of things like that because, those existing clients, those are the ones that are easier to get to come back in and continue working with. And so, giving them a little holiday gift kind of, shares the love and is a great way to get an extra tax deduction. So, let's say you spend $20,000 here, bringing in those expenses and pulling them into 2025, you're looking at a $7,400 tax savings. So an after-tax cost of $12,600, or said another way, think of it as a 37% discount. This is assuming that you're paying about 32% taxes to the IRS and you got about a 5% tax rate for the state. So it really can be a significant extra boost, and it's money that you're spending in the business versus paying out that money to the government. And so it is really a great way to bring in that extra boost at the end of the year here. Now, purchasing equipment. How can this save you thousands in taxes? Well, depending upon the scenario, it really can be a great answer. If you're purchasing items, like laptop computers or items that are under $2,500, those are 100% immediate write-off. And so that could be a tax savings of $925. So really, after tax, the net cost to you is $1,500. It's a really great thing to do. So maybe you know that you want to, you need to get new computers or items like that. And so let's make those purchases now so you're pulling in that tax benefit into 2025 versus let's say you made the purchase in the beginning of 2026. Well, it's going to take all the way until the end of the year for you to really get that benefit from that purchase. Now, let's say you're looking at purchasing something that's a little bit more costly, like the microchanneling device here, that has a $4,900 cost. Well, under the new tax laws that have come into place, we now have 100% bonus depreciation. So that sounds like fancy accounting terms, but really all that means is that, again, you can write off that full $4,900 immediately, which would bring you about an $1,800 tax savings. So if you are eyeing purchasing one of these devices or something, it's important to make sure, looking at how long is it going to take you to recoup your costs? Are you going to be able to immediately start gaining revenue from this purchase? But it really it is a great thing to do because again, it is spending more money in your business versus paying it to the government. Now, let's say you're looking at a bigger purchase like this Genesis Biosystems device. That's going to cost you $12,000. And let's say you decide you're going to finance it. So, again, because of what I had referred to earlier of bonus depreciation, you can write off this entire $12,000 immediately. So that brings you an almost $4,500 tax savings. Now, because you financed it though, at the end of the year, you are only actually having to outlay $4,000. So you saved $4,500 in taxes, but you're only paying cash out by the end of the year of $4,000. So it's a pretty great situation here if you are looking at financing. And I know a lot of times, sometimes people are afraid of doing financing. Well, there's interest and there's this and there's that, but it really can make sense because again, it leaves more cash in your business and to spend on various items and to improve what you are doing as a business owner. So it really is a great thing, even though sometimes, you'd be incurring that interest expense, which again, the interest expense is tax deductible as well. Okay, so let's talk about the FICA tip credit. This is really the best thing that has come out of the new tax law. Previously, before, only restaurants were allowed this credit. And I'm emphasizing the word credit here because this is not a deduction. This is a dollar for dollar tax reduction. So if you have qualifying tips that your employees receive, you get a tax credit for the Social Security, the employer portion of the Social Security and Medicare that's paid. So if there's $50,000 of tips, then you have a $3,800 of cash back to you into your business. This is a really, really great opportunity that you want to make sure that you are taking advantage of because it is real money back in your pocket. So I have a list here of items of how you have to qualify to be able to take these tips. And so I'm not going to go through each and all of one of these and bore you with all of the details of it, but the really important part of this is, to make sure that you're in a business that regularly and customarily receives tips, which for med spas, you generally are. And you really important is to make sure that these tips are voluntary. And so what I mean by that is think about a restaurant. When you've gone to a restaurant and you have a party of 8 or more, they have a mandatory tip of 20% on there. Those would not be qualifying tips. So if your guys' tipping system does not allow for or provide an offer of no tip, then it's not going to be considered voluntary. So you need to make sure that your tipping system works within these rules so that the tips don't become disqualified. So there's also now what's the employee tip and an overtime deduction. This is for employees. So you may be thinking, well, why am I talking about this? This isn't a tax saving aspect for my business. And it isn't directly, but it potentially could be if you're an employee in your own business and you actually work in a role that is receiving tips. And then there's also, I just wanted to point out some aspects too of like, what do you need to do as an employer in regards to this? So if you qualify for the full $25,000 deduction of tips, that could equate to about a $6,000 tax savings. And the overtime deduction could equate to either a $3,000 or $6,000 tax savings. There are income limits to this. So once your income exceeds certain thresholds, so if you're married and your income is over 300,000, you aren't allowed to take these deductions anymore. And there's also, you may have heard this, and this is getting a little technical here, and this is something I advise you to talk with your CPA or something I can talk through with you, is that if your business is classified as a specified service trade or business, that means that they would not be qualified to take the tip deduction. And definitely in the med spa world, there are some areas where you could be classified as this. So it is important to pay attention to that rule to make sure to understand. And you could end up having your employees asking about this on if the business meets this classification. For you as an employer, what does this mean? What do you have to do? Because obviously your employees, they're going to need to know, well, do I have qualified tips? Do I have overtime that qualifies? So there is going to be tip and overtime pay tracking that needs to be tracked very, very carefully. And this is something I recommend working with your payroll provider or your bookkeeper potentially to make sure you have the systems in place to be tracking this so that it can be reported appropriately on the W-2. There is relief for 2025 where these reporting requirements are not going to be in place. And we're still waiting on some more guidance on what this means and how you figure things out as an employee. But there is relief for the employers on the fact of having to report this information on the tax forms. So if and the other piece that I wanted to mention is that if you work in your business, in a position that customarily receives tips, you yourself on your personal return could qualify for the $25,000 tip deduction, which again is some substantial tax savings. And I have to say this because I do specialize in working with a lot of state tax issues as well, is that not all states may end up following these rules, which means on your federal return, you may qualify for this deduction, but on your state return, you may have to add this back. So keep that in mind as you're thinking about these things and if employees start to have questions about it. So some other tax saving opportunities. There are a lot of different things that you can do. I'm sure you guys have all heard there's so much out there on TikTok and LinkedIn, all of this. Make an S Corp election, make an S Corp election. It is a great tool, don't get me wrong, and it really can save you a significant amount in taxes, but it's not always the right answer. You need to make sure that you're working with someone who actually understands what this means and if it really is worth the extra effort to make an S Corp election. This is something I work with all my clients on. I mean, for a lot of businesses, they start out and they start as on a Schedule C, reporting this on their personal return, their business. And they've grown and things are going great and they kind of forget about looking at this and going back to it. I can't tell you how many new clients I've taken on that have a med spa and they're on a Schedule C, and it's like, oh man, you've been exceeding these thresholds of where an S Corp makes sense for a really long time and you could have saved a lot of money. So make sure that you are reassessing this and looking at it and seeing if an S Corp election could make sense, because you really can save a lot in self-employment taxes by making that S election. Make sure you're maximizing your retirement account contributions. And, maybe consider, depending on what plan you have, would it make sense to be doing Roth or traditional potentially? Roth is not going to save you tax dollars necessarily, But I have a few clients this year that kind of had a little bit of a rough year, so they're in an abnormally lower tax bracket. And so we are actually going to make sure that they do Roth contributions, and we're looking at converting some traditional IRAs that they have to Roth because they're in such a low tax bracket this year. So even when you are maybe not having a great year, there is some extra tax saving things that you could really do that would be great. Another thing is if you do have an HSA in place for the business, make sure you're maximizing those contributions because that's money that you get to keep. I mean, we all have medical expenses, and an HSA is a really, really great way to go so that you get those deductions. And then also mileage. So this is something that I have seen missed time and time again, which always surprises me. And I find in a lot of my med spas, and just clients in general, a lot of the time it doesn't make sense for the vehicle to be in the business. So we're taking a mileage reimbursement. And in doing that, you need to make sure that you are actually capturing everything that you really should be. And I have really seen this missed on a lot of clients where they have a home office and every time they drive to their business and they're driving there, that's not commuter mileage, which commuter mileage is usually you don't get a mileage reimbursement for. But because you have a home office, you can actually take that as a deduction and reimburse yourself. And I have seen that where it becomes thousands of dollars that has been missed, and is a wonderful deduction to have in the business, and it's money that's in your pocket that's not subject to tax. So make sure that you're looking at mileage and you're handling that correctly and that you have the correct documentation in place too as well. These are all things that I work with my clients on to make sure they're taking advantage of. Then also there's what's called the Augusta rule. This is an opportunity, again, to have an expense in your business and it's money in your pocket that's not taxable income. So the Augusta rule is where maybe let's say you rent some space in your own personal home to your business and you do it for less than 14 days. Well, all of that income that's coming to you for that rent is not taxable income to you as an individual, and it's a deduction in your business. So it's something to look at, and there's definitely some potential opportunities there that I think a lot of businesses don't take advantage of. Then there's also, as I've already kind of touched on a little bit here, is a home office. So I have heard so many other firms that'll say like, oh, I won't even touch a home office. We won't even do that. So, I mean, if your CPA is not taking the home office deduction, at least the safe harbor, you need to talk to them or maybe work with somebody else to make sure you're taking advantage of the home office deduction. I find so many of us now have home offices. It's so much more common. And at a bare minimum, you want to be taking the safe harbor. And what I mean by safe harbor is that it's just a minimum amount that you can deduct and the IRS essentially won't bother you about it. Um, I sometimes a safe harbor makes more sense versus the logistics of having to actually track all of your expenses to be able to take the home office deduction. But then I have others where I have one client that's in California and he's got $35,000 in property taxes. Well, taking a home office and doing actual makes a ton of sense and it gives him a huge benefit because also on the rest of his return, he's not able to deduct most of those property taxes anyway. So it at least pulls that in and gives you some more tax savings and it gives you a greater deduction. And then also having that home office is really great, like I said, about with the mileage, so that when you're driving to your med spa, you are able to do a mileage reimbursement for that because you're driving from that home office there. If you don't have a home office and the mileage that you are driving to the med spa is considered commuter mileage and it's not deductible and you can't get a reimbursement. So again, there's some things there that can be done to make sure you're taking advantage of all of those. Then there is also, and this is, the accounting terms here, and I just can't get around it with this, but what's called a pass-through entity tax election. So if you have a partnership or if you have an S corporation, there's an election that you can make to essentially pay your state's individual taxes at the entity level. And so what that means is that it's then a federal tax deduction for you. Well, you may be thinking, if you've heard, the SALT cap deduction was increased for personal returns. You can now deduct up to $40,000 on your itemized deductions on your personal return. But one, some people are phased out of that because their income is too high, or maybe they have a lot of other property taxes and everything, and they're already maxing that out anyways. So making these elections can still really make sense. And you want to make sure that you're taking advantage of that, because then you are missing out on being able to deduct all of your state taxes. I have found many a times where other CPAs are not making these elections, or maybe they don't understand them. And this is an area that I definitely specialize in. You want to be making them so that you can take advantage of that deduction. It's a really big deal for sure. And your entity structures, your type of entity matters, because, like I said, only partnerships and S corporations can take advantage of this. If you have what's a Schedule C, so you're reporting all of your business activity on your personal return, you cannot take advantage of this. So that's again where that's another piece to analyze, potentially look at. Does it make sense to make an S election so that you can actually take advantage of these types of deductions? So, I mean, those are a lot of the areas where you can take advantage of of all sorts of different types of deductions and things that are actually money right back in your pocket. They're not just moving expenses into this year. They're actual like tax savings, like the mileage or the Augusta rule, or and an S corp election, where then you can reduce the amount of Social Security and Medicare taxes that you are paying. These are all really, really great avenues that can give you that extra dollar in your business, where then you would have the potential opportunity to make some of those other equipment purchases because of the money that you're saving in this regard. And so, you want to make sure, to just be really thoughtful and cognizant of what the purchases that you are making and all of that, and make sure you can handle it from a cash flow perspective, that you can cover all of your expenses of the business and everything. And then, work with your CPA, your fractional CFO as well. Together, it really makes a lot of sense. And you can really bring that extra tax savings for the year. So that's really what I had for you guys today. I hope you guys have some questions. I'm happy to stay on here and go over any kind of questions that you guys have. Q&A. Okay. What if I use my credit card to buy supplies? I like the way, so I still get a deduction. Yeah, so if you are using your credit card, so even though that doesn't necessarily feel like that's cash out, that's considered cash out by the IRS. So if you are using your credit card, that's also another way to defer, the cash out, but you still get the deduction in the current year. That's a great question. So if a new business is losing money, would the 100% deduction be relevant? Does that larger loss carry over into 2026 when there will be gains, or would it be better than to buy in January? Yeah, so there's a couple different aspects to consider there. Because of bonus depreciation, yes, you can create a larger loss by taking that full deduction in the year, and it will carry over if you don't have other income that's going to use that up. Potentially, it might make sense to wait until January to make the purchase, or maybe not. That's something that's definitely a little bit of a deeper analysis that needs to be done. You need to look at it from a business perspective of like, well, would it make a difference for me to have it now here in November and December to generate revenue off of? Or is it better from a cash flow perspective to wait until January? And then also you need to understand what's going on your personal return to make those kinds of decisions on if it would make sense or not to create a larger loss. So I have one client where we've decided to pull some triggers to create a bigger loss, and he's going to do some really large conversions on some traditional IRAs. And he's actually going to also sell his rental, which then means that a large portion of the game is going to be taxed at 0%. So it really depends on what you have going on, and that's where it's so important to work closely with a CPA to make sure that you understand what's going on and doing whatever is the best tax answer possible. So as it is in this world of things, I hate to say it depends. Um, so when should I be meeting with my CPA to talk about these taxes? Now. I mean, if you can't do it now before the end of the year, I mean, start having these conversations next year so that you can implement some of these strategies, for the next year. But if you can talk with your CPA now, it would be really great. I am doing all my tax planning meetings right now with my clients. I just had one a couple earlier today, and going over different strategies and deciding on what to do. And should they pull these extra levers here to create some bigger expenses, or are there things to do, as Gregor was asking, if you're a business that's in a loss position, what should we be doing in that regard? Is this recorded to review? Yes, this will be recorded and we can share that out. It is a lot of information. I appreciate you guys putting up with all of that. But I think it just also, stresses the point of it where it is really important to partner with a good tax CPA that knows what they're doing, so you can make sure to take advantage of these. I mean, my end goal of working with my clients is to make sure that I am simplifying this for you, and I'm taking this off of your plate, and I'm presenting you with the options so that it's easier and quicker and doesn't feel so overwhelming. That's the important thing, like I said, of finding that good tax CPA to work with, because nobody likes dealing with this. I do think a lot of people probably dread talking with their CPA, I'll be honest. But if we can bring practicalness into this and I can present you with the options, I think it makes it less overwhelming. If I sell compounded medications and I upcharge them, do I have to have a sales tax license? That's going to be a depend again. If you're compounding medications, this is a space where in a lot of states where some states are going to potentially subject that to sales tax, other states will exempt that. So I would need to know more information, and something I'd have to look into for the particular state. And if you are compounding medication and you're shipping out to other states, that's a whole nother conversation too, because then you're having to look at a whole bunch more states' rules in particular. Like I had mentioned earlier, I specialize in dealing in state taxes as well. So that's a space that I advise a lot of businesses on. I have some med spas that, sell products online, and so they're shipping to a lot of different states. And so I help them understand what the sales tax obligations are with those. But that is a really, really great question, and it is something to be very careful of, because sales tax is a very big deal, and the liability builds quickly if you weren't collecting and remitting correctly to the state. So it is something to make sure to get addressed. Can you explain a little bit more about the deductions associated with home office use? Yeah, so I'm sitting in my home office right now, and we just moved, so I haven't measured what the square foot is of it, but let's just say it's 150 square feet, and my house is about 4,000 square feet. Okay, so I'm going to take that percentage, so 150 over 4,000, whatever percentage that is. I'm going to take that percentage of all of my expenses related to my home. So the mortgage, utilities, insurance, I'm going to take that percentage of it, and I'm going to be able to deduct that as a home office deduction. Now, there is some different ways of handling this, whether you are a business that files what I referred to earlier as a Schedule C on your personal return versus if you have an S Corp or a partnership. That's a little bit beyond the scope here. That's something that I could discuss with you on what's, how to handle that depending on your tax structure. But in essence, that's essentially what you end up getting to deduct, is that percentage of those related expenses to your home office space. And like the example that I gave earlier, for my client that's in California, it's really great because he's got $35,000 in property taxes on his home, and he can deduct that percentage of that for a home office, where most of that ends up not being deductible. So, okay, my accountant has me report the dollar value of the amount of fillers and skincare products, etc. I have, as she says that these are assets and I owe taxes on. I feel like owning filler is a liability because it could possibly expire and it could be lost. However, she says that all my products are assets and the amount needs to be reported. Is that correct? So I think when you're saying Astral, she's saying that it's inventory, and she's saying that she needs to report that as inventory on your books and that you deduct it as it's used. So depending upon your tax situation, there may be really a way to deduct that faster and not wait until the fact of it being used. The fact of the expiration does not affect the fact that it is inventory. If let's say you have it in your inventory recorded as an asset, as she is saying, and then some of it expires and you have to throw it out, it's really important to communicate to your CPA, hey, I had this in my inventory, but I had to throw this out because it expired. You can write that off then at that point in time. So it's potentially right that you're doing it that way, but there's also opportunity where maybe inventory doesn't need to be tracked for something like that. I meant is a liability. Oh, I didn't see that. I'm sorry. Um, is a liability. Okay, yeah, yeah. My answer still stands on what I said on that. Yep. When can I make an S election? Can I still do it in time for 2025, or do I have to wait until 2026? Um, we can still do it for 2025, but you're going to need to move fast here, and depending on some fact patterns, it may or may not make sense to be able to do it. But it is definitely something that's worth looking at, and making that you can do what's called a late S election, and generally it is pretty easily approved by the IRS. So there is opportunity to do it for 25. Um, I actually had a new client that was coming on. I was doing tax planning, and when I first looked at everything, I was like, oh, we'll make an S election. This would be great because he had like $4,000 of income. And then when I looked at the past year, I realized there was some issues and we won't be able to do it this year because of the tax consequences. Would actually be a negative answer for him. So we'll do it in 26. But yes, making an S election now is still a possibility.
Thank you, Nicole.
Yeah.
Wow, that was absolute fire this evening. I know we've still got a few more questions left in our chat. We have posted Nicole's contact information in the chat. Please take note of this. Webinar has been recorded. We will send it out to you guys by tomorrow morning, and each of you will get a copy of this to review the information. But man, everyone, let's give Nicole a huge virtual round of applause in the chat right now if you're still with us. I'd love to see hearts, fire emojis, a whole lot of mind-blowing reactions flying in. Nicole, you just saved the community tens, if not hundreds of thousands of dollars tonight. Seriously, thank you. Lots of great ideas for tax savings. I know there are going to be many more questions our aesthetic practices have. I just thought of a couple, while we were listening to you speak. To everyone who stayed with us all the way through and asked killer questions in the Q&A, I'd like to thank you for spending your Thursday evening with us. You're the reason we do these events, and I hope you're walking away ready to buy a new piece of equipment, stock those treatment rooms, and a high fiver to your accountant instead of crying in April. Or you can switch over to Nicole. She's always available to help you further. Reach out to her. Before you bounce away, one quick gift from us. As a thank you for being here live, you may use a or a coupon code taxes25 on medpurchasing.com, and we'll knock $50 off of any cart order over $250 spend. So stock up on those fillers, your skincare needs, needles, dermaplaning, whatever you need before December 31st to maximize those tax deductions Nicole just taught you about. Again, the code is taxes25, $50 off. This coupon code will expire on our website, medpurchasing.com, Sunday evening, November 23rd. Link is live in the chat. So that's it from us. Go implement, go save, go dominate in 2026, and have an incredible, profitable, and very happy holiday season. We'll see you next one. I'm George Beach. Take care, everyone. Good evening.
Thanks, everyone. Appreciate it.